Hello, everyone. Thank you for joining us again on Global Korea Business News. Today, we're going to have a fascinating talk with Ms. Man-yi Kwan, Senior Partner at Goldsholtz Capital in Hong Kong. Man-yi, thank you for joining us today.
Hi.
Man-yi, can you tell us about the current coronavirus situation in Hong Kong? We've noticed that the Hong Kong economy has resumed again. Can you tell us what it's like now versus pre-crisis?
Well, we've had 1,194 infections and just 7 deaths, so that's a very, very low rate. What this means is that the government can relax social distancing measures earlier on. So there has been a V-shaped recovery in street traffic, restaurants, bars, beauty salons. They are pretty much back in full swing. However, if you look at the GDP figures, we saw an 8.9% drop in the first quarter, which is pretty substantial. So the impact is very much felt in like the hospitality industry, retail, insurance business, which rely heavily on visitors from the mainland and also visitors from abroad. And until we can really relax our borders, I don't see that recovering anytime soon.
Man-yi, now let's get your views on the upcoming new Hong Kong security law. On the 28th and 29th, the People's National Congress will be having another meeting to discuss this new law. What are Hong Kong people's views on this law? Will people be taken to the streets? Do we expect a mass exodus of Hong Kong's rich because of this new law?
So unlike last year, there hasn't really been large-scale protests since the national security law has been proposed. You can say that it's because of social distancing measures, but I like to believe that with COVID-19 and us seeing chaos it has caused around the world, we now appreciate peace and order more, and we're much more concerned with keeping our jobs and businesses afloat. So the debate around this law hasn't really attracted that much attention from the general public. Once this law passes, I think we need to focus on Hong Kong's core function to China and to the world. Its core function is really China's offshore financial center. And for as long as it can help mainland institutions raise foreign capital, and for as long as China remains attractive to foreign investors, I think the city will continue to thrive.
The coronavirus has impacted both the Hong Kong economy and real estate market. Could you provide more color on this situation, please?
So I took a look at the Centerline City Index, which tracks the secondary residential market, and it's up 1.5% year to date. But I think we need to be careful looking at this figure, because the commercial real estate and the residential real estate market has been behaving very differently. So on the residential side, it's very resilient to COVID-19. We saw a brief dip in February and March, but that's pretty much gone. And both asking prices and transaction volumes are back to pre-COVID days. The commercial real estate, however, vacancy rates are at its highest since the financial crisis in 2009. So sellers have to slash prices by 25–30% to have any takers. And with our experience working during COVID-19, there's lots of working from home, maybe business owners will find it not justified to keep so many of the staff in such expensive office locations. And also with online shopping becoming a habit, I think we might not see a recovery in the retail space market.
Now, as of end of April, supposedly $31 billion of hedge fund money and other local money have left Hong Kong. And supposedly staff have also left Hong Kong. And it looks as though Japan is accelerating their efforts to get Hong Kong money and also staff by providing visa waivers, free tax advice, and even free offices. Can you share your insights on this? Should we expect a mass exodus of smart money and Hong Kong staff?
Okay, I believe there's no single measure of net capital outflow from Hong Kong. But if we use indicators like our currency, the stock market, the property market, it is showing a capital inflow. So, for example, like the HKMA has already interfered 20 times this year to keep the peg against the US dollar because of the Hong Kong dollar strength. And well, you hear on and off that there's a surge in deposits in Singapore. I haven't heard much about Japan, but there has been a surge in deposits in Singapore resulting from outflow of money from Hong Kong. But if you look at the figures, it shows that there's more money coming in. So is the money going out smarter or the money coming in smarter? Only time can tell.
Man Yi, you've been a market player for a couple of decades now, and you're a senior partner at Goldsholtz Capital. Can you tell us how the virus has impacted the Hong Kong financial market?
Well, similar to the rest of the world, I think the financial market, the financial industry probably feel the impact least out of all industries, right? Market turnover in Hong Kong have surged past pre-COVID days. So, I guess the Hang Seng Index might not be a good indicator of the real financial strength of the market in Hong Kong. But if you look at our equivalent of FANG stocks, which we call ATM, it stands for Alibaba, Tencent, and Meituan. Those are all trading at record highs. So the financial industry are actually, both buy side, sell side, auditors, financial PRs. We don't see much impact on their business. Even on the Hong Kong bank loan industry, there is an increase of 7% year on year. So impact there is also fairly muted. The worst hit is probably the insurance industry. Okay, so you're talking about like sales of insurance policy to mainland business have literally stopped since late February when we closed the borders. However, I see a very rapid recovery once we open the borders.
I see. Now, Man Yi, looking into your crystal ball, when do you foresee a full economic recovery taking place?
Gosh, I really wish I had the answer to this, but I think one observation we have about COVID-19 is that it fast-forwarded certain secular trends which were already in place before it started. Okay, so, doing business online, webinars, online shopping, deglobalization, these trends were already in place, but COVID-19 very much sped up the process. So companies which thrive in this environment are companies which are highly automated. They don't need to employ many people, low cost base. Those companies are doing very well, as reflected in their respective stock prices. Okay, companies which actually employ many people, the service industry, they are suffering and they haven't recovered. Some even have to wind up their operations altogether. So if this trend persists, high unemployment rate might be here to stay. So what we're seeing is a rapid recovery in asset prices, maybe even GDP, as the biggest companies seem to be doing very well, but high unemployment rates.
Man Yi, you're a savvy market investor. What are some of the most attractive places that investors should be looking to invest these days?
Well, as I mentioned, one of the companies we like very much will be the Hong Kong Stock Exchange, right? With the rising tension between the US and China, there's a very massive return of ADRs back to Hong Kong, following the likes of Alibaba, NetEase, JD. That's already a 794 billion market cap. And we see many more in the pipeline. So huge trading volumes. Trading volumes are up 20% year on year. And the Hong Kong Stock Exchange also signed an agreement with the MSCI to launch emerging market derivative products. So huge potential in its revenue stream and also a more diversification in its revenue structure. We like this company very much. It's also a monopoly. The other area we're interested in is the local semiconductor manufacturers. So there's now an urgent need for China to be self-sufficient in this area. So guaranteed demand, SMIC is also going to be listed back in China, so potentially much higher valuation and fresh capital.
I see. Now finally, Manyi, for our local viewers, can you recommend any stocks that they should be looking at?
Yes, our interest in the Korean market is also in the semiconductor space, right? So, of course, your Samsung Electronics, we see more sales in smartphone chips. Of course, the 5G base station chips that will contribute very much to future revenue, and it potentially gaining market share in the smartphone space from Huawei's loss. So Samsung Electronics, and also in the semiconductor space, we also like Tokai Carbon, which also produces for semiconductor equipment.
I see. Manyi Kwan, Senior Partner at Goldhorse Capital in Hong Kong. Thank you for joining us again today.
Thank you.
Thank you. Manyi Kwan recommends two stocks for local investors: Samsung Electronics, for its market share in mobile phones, and also because of its semiconductor chip business, and as well as a company called Tokai Carbon, again, for a semiconductor business. I want to thank everyone again for joining us for Global Science and Korea Business News. I look forward to seeing everyone again very soon. Thank you very much.